Welcome to Trademark Capital Management's review of the May 2024 FOMC meeting. I'll be your presenter today. My name is Peter Mauthe. Now let's take a look at what our notes were after the March meeting in 2024, which was the last meeting. After that meeting, we noted that the GDP economic growth is expected or was expected to grow the rest of this year faster at a rate of 2.1% or more. Core PCE, the prime inflation gauge used by the Fed, was expected to increase faster at a rate of 2.6%, above the 2% target the Fed wants to use. Unemployment was expected to come in lower than 4%. Keep in mind that anything below 4% is considered by many economists to be full employment. Now, let's take a look. Oh, and by the way, no interest rate change was made in March, of course, but the majority of the FOMC voting members still expected to see 3 cuts in rates this year, and 2 each in 25 and 26. Now, let's take a look at what just a little over 5 weeks did to change the view of the FOMC. After this meeting, the economic growth rate, as measured by the GDP, is expected to come in less than 2%. Now, that's good, according to the Fed. That means there's going to be less inflationary pressure in the economy. However, core PCE was expected to stay higher than the target and possibly increase further this year. Not a good thing for the Fed. Unemployment is expected to stay strong as well. Now, with two of those 3 prime measures that the Fed follows, you can see why the Fed at this meeting chose not to raise interest rates at all. Not only that, the chairman went on to say that the path in the future was for lower rates, but he made no mention whatsoever of when that might be done. Now, he made a couple points here that I think are really worth noting. There was some mention in the meeting about, not the Fed private meeting, but in the press meeting following the announcement, that asking about the possibility of a rate increase. Chairman Powell made it fairly clear that they had no intention of raising rates at the present time. It wasn't even part of their discussion, I believe he said. Now, the other thing that he said that was really quite frank and quite important, I thought, was that he said that the election would have no bearing whatsoever on the timing of any interest rate moves. Now, this has been widely accepted by almost everybody in the marketplace that the Fed would never raise interest rates close to the time of the election for fear that they might be accused of trying to influence the election. He said that was absolutely not the case. Well, of course, we'll only see as time goes by. Now, the other thing that was really quite interesting was they left interest rate policy fairly tight, but they lowered their quantitative tightening from $60 billion a month to $25 billion a month, which is actually a form of easing monetary tightness. And one analyst equated that to having your hand on the handbrake in a car and your foot on the gas at the same time. So this was a really interesting press conference following the release of the minutes. Now, I want to go back to also review the chart that I showed after the last Fed meeting. This is prepared by Tom McClellan at McClellan Financial Publications. Now, this shows in green the 2-year Treasury note yield. Now, this is important because this is set by the open market. In black is the Fed funds target rate that the FOMC sets. Now, you can see that the market tends to lead, the green tends to lead the Fed. In other words, the Fed is never really the leader, they're usually the follower. Now, what we've seen in recent months, frankly, almost going on a year, is we've seen the Fed reach their target here at 5.25 to 5.5. That hasn't changed since last year. And we saw that the open market, the 2-year Treasury note kept pace with the Fed, and in fact, much of the way up led. Then the market came to the conclusion that the Fed's next step was going to be to lower rates. Well, they certainly haven't anytime recently, of course. So the open market has had to come back up, and I've appended this graph. The red is just the extension to where 2-year rates are now, close to 5%, and the Fed is unchanged. Now, that just simply means that the market is well ahead of the Fed at this point, but that has happened before. If we go back to 2007, this same extended period of time, a year or more, back in that period of time, the market was fully expecting the Fed to cut rates, but they didn't. They stayed higher for longer, and the 2-year note kept coming back up to try to sort of get in line with the Fed, but they stayed under the Fed's target rate. And then when the open market really began to lower rates, the Fed was soon to follow. We'll see if that's the case this time and when it happens later this year. Now, you can follow Trademark on any one of the mediums in the social media. You can follow us at our website, which is trademarkcapital.com. You can follow us on Twitter. We post on YouTube, and we also post on LinkedIn. On our website, you can find our contact information. You can call us and email us. Thanks for joining us today.